Welcome to Fixed Income Markets, the essential guide to interest rates and how bonds work. Before I start, just a little bit of information about our company, Air Advisors. We are a fee-only registered investment advisory firm based in Beverly Hills, California. We've been in the business for about 30 years, and we started our company in November of 2020. And the reasons we started Air are, one, because we wanted to create a fee-only advisory firm where we avoid the conflicts of interest that can arise from a commission business. We purely charge a fair and transparent annual fee to our clients to be their advisor. We never make any commissions or incentive pay for one investment or another. The second reason we started the firm is we wanted to advise clients on all aspects of their financial lives, not just stocks and bonds. So we advise on our clients' real estate assets, on our clients' 401k assets that are held at their companies, and all assets that they have, whether they're under our management or not. Third and finally, we wanted to create our own content and our own messages to educate clients on what we feel are the most important topics in investing. And in today's webinar, we are going to talk about bonds, how bonds work. What do we mean when we say interest rates are going up or down? We're going to talk about interest rate risk and how bond prices move with interest rates. We're going to talk about how cash and short-term CD rates are affected by interest rates, how mortgage rates are affected by interest rates. We're going to talk about the various types of risks involved with fixed income instruments, why interest rates are unpredictable, and how to build a bond portfolio with that in mind. We'll talk about how call options affect bond prices. Most bonds are callable, so this is important. We'll show you the differences between premium and discount bonds, short-term versus long-term bonds, review the taxation of various types of bonds, and talk about potentially when may be a better time to buy individual bonds versus buying them in a diversified exchange-traded fund or mutual fund format. And we'll talk about bond pricing in accounts everywhere and how bonds trade. These are important things that bond investors need to know. And we'll focus a little bit on the yield curve, what it means and what it might indicate. So let me start with just the basics of what is a bond. A bond is an IOU, a request for credit, written by an entity. And that could be a corporation, a government, a municipality, to an investor. A bond is a fixed income security, and it has a stated rate of interest and fixed due dates when interest and principal must be paid. So essentially, when you buy a bond, you are lending money to a company or a city or a state or a government or some entity that is borrowing money from you. And they're going to pay you a certain amount of interest, and then at a certain point in time, they're going to pay back principal, and the deal is finished. A lot of complications come with that, so we're going to go through that and talk about how bonds work. So these are just different types of bonds. CDs, certificate of deposit that you buy at a bank, is actually a type of a bond. You're lending money to the bank. Corporate bonds are when you're lending money to different corporations. Municipal bonds, the only bonds that are tax-free, and we'll talk about taxation a little bit later, are bonds issued by cities, states, towns, and municipalities. They're government bonds in the US and worldwide. There are preferred securities, government agency bonds, mortgage-backed securities, and many, many more types of bonds. But all of these are debt instruments. So let's go through the basics of how bonds work. So we're going to start with a hypothetical example of a US Treasury 10-year bond. Again, this is hypothetical. It's actually close to where rates are right now, but not quite. So this is a hypothetical example of a bond. So this is a US Treasury 4% coupon of February 15th, 2033 at 100. So we're going to start at the price, then work back to the maturity, and then the coupon. So price on all bonds is expressed as a percentage of par value, which is usually $1,000 a bond. Pretty much in every case you're going to see it's going to be $1,000 a bond. So let's just go with that. So therefore, just add a zero to actually get the price per bond. So in other words, if you see a price of 99, it's actually saying that it's 99% of face value being $1,000. So a bond that's at 99 actually costs $990 per bond. That's just how bonds are quoted. So remember, between today and 10 years from now, the maturity date of this bond can be bought and sold in the open market. So you can buy this bond in a new issue today. You can sell it anytime you want. You can buy it back. Between today and its maturity 10 years from now, the only thing that changes on this bond is the price. So remember that point, because we're going to come back to it. The next thing we're going to talk about is the maturity. So when we say February 15th of 2033, that is the maturity date on this bond. That is the date on which the principal amount of the bond becomes due and payable. At maturity, basically all bonds are going to that reach maturity before going into bankruptcy. We'll talk about that separately, so we're going to assume that they don't go into bankruptcy. At maturity, all bonds will be worth 100 cents on the dollar. It's not that you get your money back, because you may have spent more or less than that, and we'll talk about why that might be. But at maturity, the bond will be worth 100 cents on the dollar, or $1,000 a bond. In most cases, in the vast majority of cases, bonds pay actual interest payments every 6 months. And in most of those cases, the maturity date also tells you when it pays. It pays on the date of the maturity and 6 months on the day of the maturity date and 6 months later. In other words, this bond, this hypothetical bond, pays interest to the holder every February 15th and August 15th. The last thing we'll talk about is the coupon. And this throws a lot of people off because it's quoted as a percentage, but it is actually a fixed dollar amount. So the coupon is the stated rate of interest the issuer will pay the bondholder. But remember that it is a fixed dollar amount. To understand what that fixed dollar amount is, just calculate it as a percentage of $1,000. In other words, a 4% coupon bond pays $40 a year to the holder for every $1,000 bond. So to summarize, this bond costs exactly $1,000 to buy. That's shown by the price of 100. On February 15th of 2033, the holder of that bond will receive back $1,000 of principal value in the bond. That's shown by that maturity date of February 15th of 2033. And the interest payment is going to be paid between now and then as such. They're going to get $40 a year in interest. $20 will be paid on February 15th of every year. $20 will be paid on August 15th of every year. And that's also shown by the maturity date. It tells you when it pays the interest. And the coupon rate, that 4%, tells you that it's paying $40. So basically, you pay $1,000 for this bond, you get $40 a year in interest, and you'll get $1,000 back in 10 years. So you're making 4% on your money. Now things get a little bit more complex. So now let's talk about yield to maturity. So remember that your coupon rate, that 4%, is not necessarily the same thing as your yield, because you may have paid less or more than 100 cents on the dollar when you bought that bond, because it's rare that a bond is exactly at 100 cents on the dollar. So we'll talk about why might it be higher or lower. So just keep that in mind. So yield to maturity represents a complicated formula that basically states if you buy and hold this bond at whatever price you bought it today until its maturity date, how much are you going to make per year on your money? What is your return? It is the great equalizer for different types of bonds, where you might pay more for one bond or less for one bond. It crunches all those numbers up together and essentially tells you what are you going to make if you buy and hold this bond until maturity per year. One more comment on this. So when you're buying bonds, this is generally the most important number that you need to know. So we're going to give you a couple of examples of what yield to maturity is. So that hypothetical 4% treasury that you bought at 100 cents on the dollar maturing in 10 years, if you bought it at 100 and it matures at 100 and has a 4% coupon, meaning $40 on your $1,000, your yield to maturity is exactly 4%. But between now and then, that bond is going to move around in price with interest rates. So we'll talk about how that'll happen again in a second. But let's say hypothetically you bought that bond at 90 cents on the dollar. Now you would want to know, okay, if I'm getting my $40 a year on 90 cents on the dollar, meaning I paid $900 for the bond and it's maturing at 1,000, and I'm getting $40 a year on it, and my 900 is growing to 1,000 over the next 10 years because I get 1,000 back, 100 cents on the dollar back on maturity. What is my average yield? What is my return on this bond? So at 90, your yield to maturity on this bond would be 5.3%. That means that if you happen to be able to buy this bond at 90 cents on the dollar, you wouldn't get 4% a year to maturity. You'd be making 5.3% a year on your money, okay? Conversely, if you happen to buy the bond at 110 cents on the dollar, what would be your yield to maturity? Well, now you're still getting the $40, that's the 4% coupon, into 1,000. You're getting the $40 a year in interest, but you've paid $1,100 for that bond, and your $1,100 is going down to 1,000, right? Yield to maturity crunches all those numbers together and says, if you bought this bond at 110 cents on the dollar today and held it for 10 years, you would make 2.84% a year. So your yield to maturity would be 2.84%. So again, we're going to get into why might it be 90, why might it be 110, but remember that yield to maturity is the all-important number in bonds. It tells you buy and hold this until maturity. What are you going to make per year on your money? Okay, so to understand the concept of yield to maturity, let's take 3 different hypothetical treasury bonds maturing in 10 years. So there isn't just one U.S. government bond maturing exactly on February 15th of 2033. There might be one that is issued today as a 10-year bond. That's the 4% coupon at par that we talked about hypothetically, so the middle bond here. There may have been another one that was issued 10 years ago, and let's say rates were lower. Let's say rates were at 3%, and that was issued 10 years ago as a 20-year bond at par back then. And then that's the first bond. And then there's another one that was issued, let's say, 20 years ago as a 30-year bond when rates were at 5%, right? So now you have 3 different treasury bonds, one with a 3% coupon, one with a 4% coupon, one with a 5% coupon, all going to the same maturity date. So these bonds, essentially, there's little differences, but for the purposes of the basics of bonds, essentially take it that these 3 bonds all have basically the same risk. They're all backed by the U.S. government, so they don't really have much credit risk of going bankrupt, and they're all maturing in exactly 10 years. So what would you have to expect then? You would come to the expectation that all 3 of these bonds would have to pay you about the same amount, because if one of them was paying a little bit more than the other 2, no one would buy the other 2 because they're essentially the same bond. So what ends up having to happen is that the yield to maturity on these 3 bonds has to be about the same. So take that middle bond, that 4%er at par that we buy today. That bond has a yield to maturity of 4%. So you buy it, you pay $1,000, you get $40 a year in interest, and 10 years from now, you get $1,000 back, and you made 4% on your money. Now, there's another bond, that 3% bond that we talked about. That bond only pays $30 in interest for the next 10 years. It was issued a long time ago, but you're never going to pay 100 cents on the dollar for that bond that pays $30 in interest when the current bond pays $40 in interest. And remember that between now and maturity, price is the only thing that changes. So what has to happen is you have to sell that bond at a much lower price so that the buyer makes a net yield to maturity per year of 4%. So your bond would have to be at 91.82 cents on the dollar. In other words, that 3% coupon bond, you're getting $30 a year in interest, but you're spending $918.20 on that bond, and your $918.20 is going up to 1,000. All of those numbers crunched together give it a yield to maturity of 4%. That means if you buy and hold that bond for that 10-year period, you will also make 4% a year. You're getting it a little bit differently, and we'll do a highlight of all 3 in a second. Then you have the 5% coupon bond. So there's another bond that pays $50 a year every year for the next 10 years and also matures at 100 cents on the dollar in 10 years. Well, now the seller of that bond is not going to let it go for 100 cents on the dollar when prevailing interest rates are at 4%. So that seller is going to command a premium, and that bond would also have to have a yield to maturity of about 4%. So that bond will trade at a little over 108 cents on the dollar. So in other words, on this bond, you're spending $1,081.80. You're getting $50 a year in interest. And then 10 years from now, you're getting $1,000 back. All of those numbers crunched together give the holder, the buyer, a yield to maturity of 4% per year. In other words, all these three bonds, because they are so similar, they're backed by the same entity, they have the same maturity date, they really would have to have about the same return. So the market uses yield to maturity to equalize it. All three of these bonds give the buyer a yield to maturity of 4% per year. The way they're doing it is different. The middle bond, the standard plain vanilla, that's called a par bond because it's trading at par value at 100 cents on the dollar. You spend $1,000, you get $40 a year in interest, you get $1,000 back in 10 years. The 3% bond that's trading below 100 is called a discount bond. That is you're getting a smaller income payment, but your money is also growing. So you're getting some growth and some income for your 4% a year. The 5% may be for somebody that needs more income today and wants to get the $50 in income and doesn't mind that their principal value is going to drop. All of those things are still going to be 4% per year to maturity. So the important thing here is to understand the concept of what yield to maturity is. And it's the great equalizer that says, if you buy and hold this bond till maturity, what are you going to make per year? Another far less important number to understand regarding bonds is current yield. Current yield is simply the coupon of the bond divided by the price. So on that first bond, that 3% bond divided by the 91.82 price means on your 91.82 price that you're paying, and you're getting $30 a year in income, you're getting a 3.27% current income. On the 4% one at par, you're getting a 4% current income. And on that 5%er that you spent 108 on, you're getting a 4.62% current income. This number doesn't really matter as much as yield to maturity because it doesn't tell you that that bond is going to move up or down in price between now and maturity, right? It just tells you dollar for dollar, what are you netting on your money for getting any price movement. Not as important, but still something that you should be aware of. Some assumptions in yield to maturity. We'll show you the formula. Don't want to get too complex here, but the assumptions are important to understand. The assumptions of what goes into the yield to maturity calculation are that one, the bond is held from now all the way till maturity, right? Because if you sell it before that, it could be higher or lower than that in price, and your total return could be different. This is assuming you're holding it till maturity. Two, it assumes that the coupons that you're investing every 6 months that you're getting are reinvested immediately. And three, that those coupons are reinvested at the yield to maturity rate of the bond today. So these are just assumptions that go into yield to maturity. The next slide shows you the complicated formula. There is a way to calculate this. It comes with a lot of trial and error. Basically, just get a bond calculator, or you can even get these calculations off the web to calculate bond yield to maturities. But if you're ever buying a bond, those yields are already calculated for you from wherever you're getting them from. To get a good understanding of bonds, we really should discuss the various types of risk, in particular credit risk and interest rate risk, and what they mean. So these are the various types of risk that are associated with bonds, and there are certainly more, but the main ones to focus on are quality risk, interest rate risk, and call risk. The other ones do exist, things like liquidity risk and reinvestment risk, but I want to focus on these first three because they're going to really help explain how bonds work to you. So let's start with quality risk or default risk. There are primarily three companies that rate the quality of different bond issuers, and they're rating basically the balance sheet of the bond issuers. Those are Moody's, Standard & Poor's, and Fitch. I've shown you Moody's and Standard & Poor's ratings here. The highest quality is considered AAA by each of those entities. Then S&P goes into AA+, AA, and AA minus. The equivalent from Moody's is AA1, AA2, and AA3. Then S&P goes to A+, A, and A minus. Moody's is A1, A2, and A3. And then S&P goes to the triple Bs. Anything under triple B minus and under Baa3 for Moody's, anything under those is considered high yield or junk bonds. Anything above those is considered investment grade. So what would you expect as you were going higher on this chain, all other things being the same? What's obviously going to happen is you're going to get less interest. You are going to make, all other things being the same, less interest on a AAA bond that doesn't have the risk of default than you will on a double B bond that has more of a risk of default, right? So that's what quality or default risk is. Because the worst thing really that can happen when you buy a bond is that the entity that issued you that bond goes bankrupt, and then your principal payments and your interest payments stop, and then it goes into a whole different category. Bankrupt bonds have had recovery rates as much as 100%, but generally that's when people lose a lot of money with bonds. So you really want to try to minimize your credit risk. So before we go into interest rate risk, just one observation to think about on credit risk. Generally speaking, if you were going to buy slightly lower quality bonds to get more income, you're probably better off buying those in a very diversified ETF or mutual fund format. We generally recommend ETFs for the lower cost, but you want to buy those in a very diversified basket so that you're minimizing the credit risk of any one issuer, even though there's a cost to that basket. So even if you buy an exchange traded fund, there is a little bit of a cost to it, but you're getting a very diversified portfolio. But if you're buying super high quality bonds, government bonds, high quality municipal bonds, CDs, and so forth, generally you're probably better off buying those individually because there's such a low risk of default that you don't need to be paying anything out in terms of an ETF or mutual fund fees. So to that end, we want to talk about observations in investment grade municipal bonds versus corporate bonds and the default rates. So 10-year average cumulative default rates, corporate bonds in these different categories. So if you look at triple B rated corporate bonds, 3.61% default rates over 10 years. With municipal bonds, the number's been considerably less. In fact, triple B rated, BAA rated municipal bonds have generally had a lower default rate than A-rated corporate bonds. So entities that are municipal in nature, cities, towns, generally tend to have far less defaults because they're always around, but corporations over long periods of time do tend to have more defaults because times change substantially and the businesses that are doing well change substantially with the times. So keep that in mind. What types of bonds should you buy in individual formats versus diversified formats? Now we're going to talk about the most important concept really other than yield to maturity for you to understand, and that is interest rate risk. What do we mean when we say interest rates are going up and down? In the bond market, we are not talking about what the Fed is going to do. The Fed raises or lowers the Fed funds rate, which is basically the overnight rate at which banks lend money to each other. It is an overnight rate, and that is set basically by the Fed. When we talk about where interest rates are, we're not talking about that when we're talking about bonds. We generally use the benchmark treasury rates, meaning the current yield to maturity on the 1, 5, 10, and 30-year treasuries, U.S. government bonds. And the whole bond market tends to use those as benchmarks about where interest rates are. And we'll talk about what moves those rates, but that's an important concept for you to understand. As of yesterday's close of business, just to give you something that's a little bit more real life, here are current interest rates. The Fed funds rate is at 4.5 to 4.75%. So we basically say 4.75%. The 13-week Treasury bill is at 4.64%. The 5-year Treasury bond is at 4.04%. The 10-year is at 3.81%. And the 30-year is at 3.85%. That's as of yesterday's close. The Fed only moves that very first rate, the Fed funds rates. The rest of these rates purely go by supply and demand. In other words, it is a market just like the stock market. How many buyers, how many sellers? But that market factors in what is the Fed going to do? What have they said that they're going to do? What have they indicated? Where do we think interest rates are going to go? And there's constant buying and selling based on predictions of that information and other factors. So that's what makes interest rate predictions impossible to predict because the bond market instantly prices in all of that knowledge into these rates. So you might look at this and say, well, the 13-week Treasury is yielding 4.64%. Why would I put my money into a 10-year to get 3.81% when I can get 4.64? But when interest rates are inverted like this, meaning the longer treasuries pay less than the short ones, which is not the norm. Normally, the yield curve is higher, so you're getting more and more interest as you go out longer. So keep these current interest rates in mind because we're going to come back to them with a discussion of interest rates. Now let's try to illustrate what interest rate risk is. So now we're going to create two additional hypothetical bonds. We'll use a short-term bond example of a one-year treasury maturing, and we're going to use the same coupon for both of them just to keep the math simple, of 4% maturing 2/15 of 24. And we're going to use a long-term bond example of a 30-year treasury of 4% of 2/15/53. So in that short-term bond example, so let's say you bought this bond, the 4% coupon at par, and let's just say for the sake of the math, like this is probably something that has never happened and might never happen, but let's say that the second you bought it, interest rates on the one-year treasury spiked up from 4% to 5%, and you want to sell your bond. Well, no one's going to buy your bond that's paying a $40 interest rate payment because you bought it at par. No one's going to pay you par value for your bond that's paying 4% when they can go elsewhere in the market and get 5%. And remember that price is the only thing that changes between now and maturity. So if you want to sell this bond, you bought it at 4%, rates went up to 5%, there's a year left in it, you're going to have to sell this bond at a lower price. The price of the bond will have to have a yield to maturity of 5% because rates have gone up, right? So at 99.04, your bond that's paying $40 in interest, at 99.04, it'll have a yield to maturity of 5%. That means a buyer will get $40 in interest, they'll spend $990.40, and in a year will get $1,000 back. All of those put together make it 5%. So if interest rates have gone up, bond prices go down. On a one-year bond, you only have that deficit for 1 year, so it only goes down slightly in price. Now, the other side of the coin is, what if rates go down from 4% to 3%? Now, you're not going to let go of your bond at 100 cents on the dollar when prevailing rates have gone to 3%. So your bond is going to trade at 100.98 cents on the dollar because that'll give it a yield to maturity of 3%. So in a one-year bond, a relatively big move in interest rates still doesn't move the bond price around too much because at the end of the day, that bond's going to be worth 100 cents on the dollar in 1 year. So your 4% bond, you don't need to sell it. If you hold it for the year, you'll still make your positive 4% per year. You could have waited and gotten 5%, but there's no way to guess that, okay? And we'll talk about how to create a bond portfolio with that in mind. But I just want to talk about what interest rate risk is and how it works. Now let's talk about the 30-year bond. Now let's say you bought a bond and you locked in that 4% coupon. So you paid $1,000, you're getting $40 a year in interest for 30 years. And let's say again, for the sake of this example, that interest rates all of a sudden go up and the interest rate on the 30-year bond has gone up to 5%. Now, no one's going to come and pay you 100 cents on the dollar for your bond that's paying $40 a coupon every year, where they can go elsewhere and get $50 a year in interest. And remember, price is the only thing that changes between now and maturity. So what's going to have to happen is your bond price is going to have to come down so that the buyer gets a yield to maturity of 5% from the bond that they're buying from you, right? So in order to do that, interest rates go up from 4% to 5%. Your 4% coupon bond, now you're paying $40 a year. They need to get $50 a year for 30 years. In order to make them whole, you're going to have to get your bond price all the way down to 84.55 cents on the dollar. So if the buyer comes and gets your 4% coupon bond at 84.55, they're giving you $845, and they know they're going to get $1,000 back in 30 years. All of those numbers crunched in together give them a yield to maturity of 5%. So interest rates on a 30-year bond went up 1%. Your bond dropped more than 15% in price, right? So going back to the prior slide, the one-year bond dropped less than 1%. On a 1% move, the 30-year bond dropped 15%. But on the other hand, what if rates go lower? Now, you are not going to let go of your 4% bond when rates have gone down to 3%, for example. So you're going to command a premium so that your bond has a yield to maturity to the buyer of 3%. So now your bond goes all the way up to 119.69 cents on the dollar. So now the buyer is going to get $40 a year in interest, but they're going to have to spend $1,196.90 for your bond, and they're only getting back 1,000 back in 30 years, all those numbers crunched in together give that bond a yield to maturity of 3%. So, but keep in mind, the reason they say bonds generally are more conservative than stocks is if you held this bond, this long-term bond, and prices went down that much, in 4 years, your total return is still slightly positive because you dropped 15% in price, but you made 4% times 4 years, you made 16% in income. So you didn't really lose money, but you basically were flat for that 4 years. But what's important to understand here is that long-term bonds move around a lot more with interest rates than short-term bonds. So they carry a lot more interest rate risk. We're going to come back to the main lessons to be learned here, but this is what interest rate risk is. The next concept that we're going to discuss are calls. Most bonds, not all, most bonds are callable. What is a call? A call is that the issuer reserves the right to pay back a set amount, usually 100 cents on the dollar. Sometimes it could be more, but let's just say it's 100 cents on the dollar at a set point well before the maturity date and pay the bonds off in whole, right? So now you haven't really locked in for that whole period of time because they have the right to call the bond away earlier, okay? So yield to call is another number that you need to know. When you buy a bond, you generally always want to know the yield to maturity, but if the bond is callable, you also want to know what the yield to call is. If you buy the bond at par, the yield to maturity and the yield to call are the same number. But if you buy it at a premium, the yield to maturity is going to be higher than the yield to call because you're going to lose that premium faster if the bond gets called away. We want to illustrate what call risk is and how that could affect the bond. So in our long-term hypothetical example, that 30-year treasury, if that bond was callable at par starting in 1 year and yields dropped to 3%, what is likely to happen? Well, the answer is that bond is not going to move up to 119.69 cents on the dollar, as it did on the example we gave earlier, because they have the right to take it away from the holder at 100 cents on the dollar only 1 year from now. So what that call did is it kills the upside of the bond because the issuer has reserved the right to take that bond away earlier. So one idea that you need to be aware of when it comes to bonds is the idea of call protection. And that is, when is that bond callable? If a bond is callable in 1 year, you don't have too much call protection. That means it can get taken away from you in a year. If that 30-year bond is not callable for 10 years, at least you've locked that rate in for 10 years. And if that bond is non-callable, you've actually locked it in for the whole 30-year period. So you always want to know what your call protection is. Now, a call is not always necessarily a bad thing because you will get compensated for that. The issuer has to pay for that call option. In other words, in that hypothetical example, if that bond was non-callable, that 4%er at par, a callable bond, a bond that's callable in 10 years might have to pay 4.2% because you're only locking it in for 10 years. That same bond that's callable in 1 year might have to pay 4.5% because you're taking 30 years of interest rate risk, but only locking it in for 1 year. So you do get compensated, but it's important to be aware of what calls are and how they impact bonds. Continuing with bond basics, now we want to understand what premium bonds are and what discount bonds are. So given our non-callable examples from earlier, those 10-year bonds, that 3% at 91, the 4% at par, and the 5% at 108, the 3% bond at 92, again, is the discount bond because it's trading at a discount from par value. It's trading below 100. The one in the middle is called a par bond because it's at 100. And the one that's trading at 108 is considered a premium bond. It's trading above par. What are the advantages and disadvantages of a premium or a discount bond? So if rates increase, if interest rates go up and bond prices go down, which would suffer a smaller loss? That 3% coupon that you bought at a discount or the 5% coupon that you bought at a premium? The answer is that the 5% coupon would suffer a smaller loss, not only a little bit less in price loss, but also because you're making a 5% coupon each year instead of the 3% coupon to dampen your loss. But on the other hand, if rates go down, and remember, most bonds are callable, which bond is more likely to be called away? The 3% bond at a discount or the 5% bond at a premium? The answer is the 5%. So the issuer has the ability to stop paying the 5% coupons. They're going to do that, and you're not locking that rate in for a longer period of time. Now we're going to summarize this, talk about rules to remember, talk about interest rates, and then talk about how to build a bond portfolio. So the basics of what we were just talking about, generally speaking, the benefits of longer-term bonds are that they will usually pay a higher interest rate because you're taking more interest rate risk. They're beneficial in a decreasing interest rate environment because you get to lock in the higher rate for a longer period of time. The negatives of long-term bonds are that they have more volatility with interest rates, so they'll have a bigger price drop if rates increase. The benefits of short-term bonds are that the principal is returned to you more quickly, so you have easier access to your funds and less price volatility with interest rate movements. So they're beneficial in an increasing interest rate environment because you're going to get your money back and you're going to get to reinvest it at a higher rate. The negatives of short-term bonds are that they usually pay a lower interest rate because they're taking less interest rate risk. Not always the case. We'll talk about that. And then your principal is returned more quickly. So if rates go down, it's reinvested at an even lower rate. Finally, to talk about the premium versus discount, for two bonds of the same issuer with the same maturity date, the higher coupon premium bond has less volatility, more current income. It's better in an increasing rate environment, whereas the lower coupon discount bond has better call protection, more upside potential, and it's better in a decreasing interest rate environment. So one concept that we always try to educate clients on is the efficient markets hypothesis. And this is a theory that is taught in virtually all the business schools worldwide. It is widely accepted, not unfortunately talked about too much. It's widely accepted to different degrees by different people. But what this theory says is that asset prices in an efficient market reflect all relevant, available, and known information, as well as the market's consensus expectations about unknown information. And what this theory is saying as it comes to the bond market is that it becomes impossible to predict where interest rates are going because the bond market instantly prices in all news and information, and it prices interest rates where it thinks they should be at this time, which is why interest rates are impossible to predict. In fact, this is a survey that the Wall Street Journal has done for 40 years with a survey, a team of economists, and all they have to predict is the interest rate on the 10-year Treasury going to be higher or lower in the next 6 months? And it's a 50-50 guess, and throughout that time, they have been right only 37% of the time, about 1/3 of the time on a 50-50 guess. And the reason is because the bond market is very efficient and it prices in these predictions and it already knows everything we know essentially. So making interest rate predictions is really not the best way to go because they're impossible to predict. So if you could predict interest rates, and if you knew interest rates are going higher, you're going to leave all your money in cash or short-term bonds, wait for rates to go higher, and then reinvest it. And if you knew rates are going to go lower, you would lock in the long-term bond rate because your bond price is going to go up when interest rates go lower, right? But because it's impossible to predict interest rates, what do? So some strategies are, one is laddering. So you can buy a 1-year, 2-year, 3-year, 4-year, 5-year, up to a 10-year or even a 30-year, buy different years so that you're locking in the rate on longer bonds and then at the same time have some shorter term bonds in case rates go higher. The second thing is diversification by maturity date, by the issuer, premium versus discount bonds, lots of different factors to how you can diversify. So, and the third is periodic purchasing. So you can buy some now, some in 6 months, some in 12 months. But these are strategies in terms of portfolio construction and to avoid trying to make those interest rate predictions because they've been proven over time not to be predictable. Now we're going to talk about taxation because it's a very important component of understanding bonds. So when we talk about bonds, it's really important to understand taxation for taxable accounts. We're going to talk about what states have no income tax, because that affects how those people in those states would invest in bonds a little differently. We'll talk about what bonds are fully taxable, what bonds are fully tax-free, what bonds are federally tax-free but state taxable, What bonds are state tax-free but federally taxable? These are the states that have no income tax. So if you are lucky to live in one of these states, you do not pay income tax to the state. So the income that you're getting on bonds, if it's fully taxable, you'll pay federal but not state in any of these states. But what about the bonds themselves? So different bonds are taxed differently. So I've split these into 4 different areas. The first batch are bonds that are fully taxable. So those are corporate bonds, some agency bonds such as Fannie Mae and Freddie Mac, CDs, mortgage-backed bonds, and then fully taxable municipal bonds from states other than your state of residency. So let's talk about that. And we'll start with fully tax-free bonds. The only bonds that are tax-free are municipal bonds. These are bonds that are issued by cities, states, towns, some schools, and things like that. If you buy tax-free bonds from the state where you are a resident, you do not pay federal tax or state income tax. It's important to note that Puerto Rico, Guam, and other U.S. territory municipal bonds you don't pay state income tax in any state. But municipal bonds are federally tax-free. For the bonds in your own state and the territories, they're also state tax-free. But if you're a California resident, for example, and you buy a Washington state bond out of California, you're going to have to pay California state tax. So for the states that have income tax, those holders pay tax on bonds of outside states. So most people in high tax states tend to want to buy the bonds of their own states. But the ones that are in those states where they don't have an income tax, they can buy municipal bonds from all 50 states because they're federally tax-free and there is no state income tax. So those are fully tax-free bonds. And then finally, the state tax-free but federally taxable bonds, U.S. government bonds, treasury bonds, you pay federal income tax. You do not pay state income tax in any state on those bonds. And then they're taxable municipal bonds as well. They pay more income than the tax-free versions. People tend to buy those in retirement accounts, for example. If you buy taxable municipal bonds from the state of residency, so California, buy taxable municipal bonds, we'll pay federal but not state. But if we buy outside, we're going to pay federal and state on those, okay? And so just keep in mind the taxation. Rather than going through all of these, those are the main highlights. This is how various bonds get taxed. It's important to understand how bonds trade. The vast majority of bonds trade in a dealer-to-dealer market. That means if I have a bond that I want to sell, I go to my brokerage firm and say, I want to sell this bond. They in turn take that bond and show it out to the street, and all these different firms see it. Different firms come and outbid each other. They leave it out there for a while, and then whatever the best bid is at the end, that's the price on the bond. It is a very manual system. And the reason it's a manual system is because there are far more bonds out there than there are stocks, and there are very thinly traded bonds out there. So by nature, it has to be primarily a manual system, but they literally go out and just wait for different people to outbid each other, and then that's the price on your bond. So because of that, when you see a bond quoted in your brokerage account, there is no way that that computer-generated quote is going to be spot on. So all of the firms use one of 3 or 4 pricing services whose job it is to try to take either latest trade information on a particular bond, or if a bond hasn't traded, they'll look at a credit quality and a maturity and a coupon and assign a ballpark price to it. So it's important for you to know when you see a bond price quoted in your account, that is almost never identical to what you'll get when you actually go to sell it. You may get slightly more or less for that bond. Bonds also have spreads to them. Even with no commission, there is a difference in the buy price and the sale price, the bid-ask price of a bond, that's generally bigger than it is on stocks because it's more of a manual system. So in conclusion, the most important concepts to understand about bonds are the idea of yield to maturity, calls, quality risk, interest rate risk, and you should also be aware of how bonds trade and how they're priced in your account. If you'd like more information, please feel free to look at our website, www.airadvisors.com. We hope you found this to be educational and enlightening, and we wish you happy investing.